Hey, everybody, welcome back to the Passive Money Podcast. Today, we're going to talk about the upcoming recession. I know it's not in the news yet that we're in a recession. I know it's not. In the financial news, they're not talking about it either. But a technical term of recession is two consecutive quarters of GDP decline. We already had the first 3 months of recession or the first quarter of recession from January to March. The next reading for the next quarter will come out in July. But this is what we do know. What we do know is gas prices are at an all-time high. Rents are at an all-time high. Home prices are at an all-time high. Groceries are at an all-time high. And it's not sustainable. It's not sustainable. So with that, we're going to dove into the recession, who will be affected, who will be the winners and losers in this situation. And let's take it from there. Alex, what you got?
As you were saying, it looks like one is coming up. They haven't talked about it yet, but everything is pointing towards one. So, as we talked about, you don't think that it'll be as severe as the last recession. So it doesn't look like home prices are going to crash to, $30 a house, but it is looking like due to, all the rising inflation and everything, there is one coming. Now, one thing I would like to talk about on this episode is, job security for those who are in the workplace, which is the majority of America. Who is protected, and maybe even a comparison to who would be protected in this recession, compared to the last recession. If it's the same people in the same workforce in the same industry, or is it now a different industry? How are the times moving in today?
Well, that's a good question. That's a great question, actually. And we can just go on just the news that's been coming out lately. And this is probably not news that's known by mass majority of the people, but because I pay attention to financial news and publicly traded companies, and read their earnings statements and read their conference calls and things like that. Yeah, I'm a nerd. You already see it. You see the lenders, the rocket mortgages, the home mortgages, big sections of bank, the lending services side, they're laying off people by the droves already. They're already doing that. So because the interest rates has risen, 5, 6% for a home mortgage, the demand for housing is not as high as it was back in COVID when it was down to 2, 3%. So when the COVID collapse happened and the interest rates dropped, they hired a crap ton of lender writers and underwriters and things like that to service the demand for all of these new mortgages that was coming on. But now, as you see from CNBC, home demand or home buyer demand is down 16, 20%, month over month. So that sector is already taking a hit. If you look at Twitter announced that they're going to put a slow or a pause on hiring. You can keep going down the line of litany of companies. Microsoft just announced that they was doing the same. I mean, Uber was a job anybody could get as long as they had a car that was functioning well. Uber came out and said now Uber will not just hire anybody that has a good car. To work at Uber, it has to be a privilege, not just because you have a car. So Uber has slowed down on the hiring of drivers because the cost is getting out of hand. So if these major corporations are pausing hiring, freezing hiring, and you can go on so on and so forth, the Facebooks, the Googles, and all other big trillion-dollar market cap companies, if they're slowing down the hiring or freezing the hiring, and they have all these billions of dollars in their coffer, what do you think the smaller companies are doing? And a reason behind that is because the feds are raising interest rates, and that means the cost of capital. I say it all the time, the cost of capital, but what I'm saying is the amount of interest on the money that they're borrowing is rising. So that means their monthly payments are higher. So when they was borrowing money at 1%, it was almost free to borrow the money. But now they're paying 5, 6, 7, 8% to borrow the money. They have to generate the revenue, and because it's a public company, they have to still increase profits, increase revenues, and things like that. But now they have to pay more for debt. So how will they, meet that bypass of making more money? I mean, paying more on debt. they will freeze hiring. Then from freezing hiring, they will start laying people off, and then laying people off so they can use those salaries that they was paying those people to cover the debt, especially if we're going into a recession and the economy is contracting, demand is contracting. It's less people that they will need to run operations, and the easiest way for a company to generate more money or more revenue to pay off debt is to cut employees. Well, Alex, with all that being said, so we know that we have all these higher prices. Now we know a little bit about the, cost of capital and things like that. What areas do you think will be most affected work-wise as employees? Work-wise, what areas will be most affected when it comes to cutting employees or slowing down hiring? What sectors in the market you think will have the hardest time
I think
if a recession was to come?
I think it'll be any industry that's in the wants business. Um, so like I'll say like the company that I work at, they are definitely a wants business. They sell furniture, and from experience working there, from being there day to day, I can already see that sales have declined. 2020, say the mid to end and leading into 2021 was like the best time for our company in all of its existence. We made the most sales out of like every year prior to that. This year, sales are going down, revenue is decreasing, there's less deliveries, not as many people are buying, they don't have stimulus checks, so we're seeing a lot of less consumers and customers. Even if we are a leading competitor in the market, that makes no difference. So really, I don't think business is going to stop in industries that are in needs. Publix is still packed. For viewers that don't know what Publix is, it's a grocery store. Walmart's still packed. Even things that might be considered wants, but in today's society are considered needs, such as cell phones. Tech in that area where a company needs that tech, such as computers, cell phones, Wi-Fi, to thrive and exist in this economy. Things that, Apple, crazy thing how people think that they need a phone to survive. I think there's actually a phobia for people that lose their phone now. So it's just like that, so things that you wouldn't think are needs, but in today's society have gradually incorporated themselves into being a need. So that industry I think will be fine, but industries as far as clothing, retail, as far as furniture, anything that is a desire or want is gonna get affected in this environment.
Yeah, I agree 100%. And when you add on the top of it is gas prices don't look like it's dissipating no time soon. We're gonna have this purge during the summer because vacations, people gonna get their last hoorah of that. But yes, it's gonna be a lot of people that's gonna be hurting. There's gonna be a lot of people that's gonna be hurting. Like, the unemployment number came out a month ago, and it said that it's double the amount of job openings than it is people unemployed. No matter how you feel about the number, that's still a backwards indicator. Even from now, that has slowed down a lot, because even though it might be job posting, a lot of companies have slowed down the hiring. They've slowed down the hiring dramatically. You have some in the service space. Even I was out at a restaurant yesterday. It's actually a major restaurant, and the capacity was maybe 20-30%.
Right.
20-30% at a restaurant. That I used to go to, and it was 80-90% capacity. It was only like a 20 or 30%. And the people on the employment side, those people, and as you stated, the needs business is the ones that will stay in the game way longer, because no matter what, when people start cutting back, the first thing they should cut back is their wants, and then the needs. They got to take care of their needs by hook or by crook. The demand for the needs will go down, but they will still need people to do that. And then, as far as employment wise, companies will find ways to be more efficient, like automation. People should start listening for that word around here, workspace, when they start talking about automation or automating things or being more efficient at things, what they're saying is we have to find a way to get the same work done with the fewer number of people. And I've worked in an industry that has fully automated almost everything, and the workforce went from 1,000 people down to 100 people. And that is where companies are going because they have to be more efficient, especially publicly traded companies. They have to be more efficient and keep showing that top line growth and that bottom line growth. And the way to get that stuff still to grow, even in recessionary times, is by cutting expenses. And one of the biggest expenses for an employee is the employer. So if they can find a way to get the job done without as many employees as they have, that will be an avenue that they choose to do. So be prepared for that to come out.
Right. And like, so especially in the investing world, not even just for consumers, but looking back in 2021 and 2020 when COVID first hit, as the market dropped, but then dramatically went up from there, there was a lot of new investors trying to seize the opportunity on the market, thinking, oh, this is the time to make money. And with interest rates dropping as much as they did, companies, as you said, taking essentially free money in form of loans and applying it to grow their businesses did very well in that environment. But as you're seeing now, those same businesses are crashing, stock market, stock value wise. And, investors that were in those stocks have now lost the value today. And so as an investor as well, you got to take a step back and think, okay, who is going to thrive in both environments, ones that are doing good and ones that are doing bad. And I know one that we talk about in class, I don't think we brought it up on this channel, but Altria Group, how, they sell tobacco products and they're getting invested in the, we have to censor this, but the green space and the green smoking space. And, so a company like that, consumers are going to be, consuming their products in a good time and in a bad time. And especially in bad times, and they're going to be consuming it even worse. So really, as an investor, just take a step back and, don't just think everything's just going to go up. You can invest in any industry technically, but which ones are going to actually be profitable for you in, not just in the long run, but throughout all times.
Going back to, like you said, about the Altria, a dividend king or aristocrat, I get those back twisted up, but they pay a dividend for a long time. But like you said, in good times they're gonna smoke. In bad times, recessionary times, people will have more stress on them. They'll be figuring out more things. They will smoke more. So if you're looking at a chart, or if you pull up a chart of Altria or something like that, during this collapse since January of 22, since the stock market's collapsed down 20%, Altria has been going the opposite direction. Altria has been going up. People have pivoted to going to the staples like Altria for safe haven, for preservation of capital and things of that nature, because they're paying a dividend. The stock is a stable stock, and people have that mindset. When the market is going haywire and they don't understand what's going on, they revert to the names that they know and love. Back when in 2022 or 2020, when COVID happened, people was in every growth name and things like that. And people that's out there, and if you invested in the next high flying growth name that is not making a profit, the company itself is not making a profit, those are the companies that is going to get hit the worst in a recession. And you've seen it since the beginning of the year, or since actually November of 2021, when Jerome Powell was in front of Congress and he said that the use of the word transitory when it came to inflation was off base. And even though the stock market, the S&P 500, has dropped 20%, those growth names, and it's a lot of them out there, so I'm not going to start naming them, they've dropped 60, 70, 80% in that time frame. Kathy Woods, I like her as an investor. She just She's in stocks that are very growth heavy, very price to sales heavy. And in this environment, the stocks that's going to outperform is the ones that are the ones that have earnings, that have profits. Or if you could look at it as the inverse, you want to, if you're a growth guy, a growth tech gal, what you want to do is those stocks that you still think have a long base future, you want to invest in them when they're at their lows, when they're down 60, 70%. Don't invest in them when they ran up 40, 50% and say, oh, I want to jump on those when it's coming down and you still believe in the company. And what I mean by believing in the company mean doing your due diligence, not because you heard somebody on YouTube say it, not because you saw it in the chat room. I mean, physically listening to conference calls or reading the transcripts from conference calls, looking at companies' earnings, actually know what they do. If you cannot explain in less than 10 seconds what a company do to make money, you shouldn't be investing in the company. It's simple as that. But when you invest and you want to use a dollar cost averaging method, meaning like, so if you getting paid every week or every 2 weeks, you set aside a amount of money, $5, $20, $100, $1,000 every paycheck to keep investing. No, you're not going to catch the stock at its bottom. No, you're not going to catch the stock, but the average cost will give you, just keep buying over a long term, and the average cost basis will be lower and you will be rewarded in the future. But going back to investing in stocks, if you don't have the time or you don't believe you have the time, I think everybody had the time, and you not as efficient of understanding what the market is and things like that, don't sit there and try to jump into individual stocks, because individual stocks, you have to do your homework. You have to do the homework. And I think that's a big area where people lose the concept of what the stock market is. They just think that, oh, I see a stock for $2 is going to go up over time, and the company could be total crap. And that's where I think, Alice, I think people lose that mindset on it. And I think that people that's not willing to do the homework, they shouldn't invest in stocks, individual stocks. They should invest in an index fund or an index mutual fund, something that's pegged to the NASDAQ QQQs or pegged to the S&P 500 or SPY, something like that, that's low management fees, that will follow the index of the market, which generally over a long period of time will average about 9 to 11% per year gains. And that's probably the best way, or I believe that is the best way that people should invest, for the majority of the people, that they should invest over the long term, or if they try to take advantage of getting in during a recession when the market is down.
Adding on to that, I think it's key that people keep in mind that when they are investing, in a recession, or say, the recession hasn't been officially announced yet. So in this market right now, as if you look at the markets, the S&P and the NASDAQ are both down, Dow Jones, all that. The good companies as well are down, but you have to look, as you said, do your homework. You have to look at their earnings reports, look at their statements, look at their growth. Are they still growing? Are they still producing? SoFi is a huge one that we're talking about all the time in class. I mean, they're down a crap ton, but the stock, or the company, I should say, is still doing what it's always been doing, still showing growth, still showing progress. And if you continue to do your homework, you can find the companies that are down, still growing, and buy them at a discount. Now, of course, the stocks that were only thriving when everything else was thriving, they're down too, but they're also losing revenue, losing profit, losing everything. But the companies that are doing great are also going to be down, and taking advantage of the fear in the market is definitely key in environments like this.
Yeah, and Warren Buffett said it best: the market could be irrational longer than you could be solvent. Buy when it's blood in the streets. And right now, we're in the blood in the streets. Bear market territory down 20% is blood in the streets environment, and finding times to take advantage of them. I mean, we talked about a couple stocks that we took advantage of in the class, but that's what you have to do. You have to be able to stand in front of a Mack truck sometimes. But the reason why you can stand in front of that Mack truck and not worried about getting ran over is because you've done your due diligence, you've done your homework, you know what the company's financials is, and the market can be irrational. So when you get a big drop in the stock where you've been doing your homework and you know that the stock is performing well, the market can be irrational and sell it off. And that's giving you an opportunity to buy at a discounted price. So you always got to have that capital sitting on the side, waiting to deploy it in instances like that. And Alex, we took advantage of a couple last week. We're not going to mention no names, but let's just say Alex jumped on one and he was up about 2 weeks ago. He jumped in on one and he's up 100%. Again, in a bear market, he's up 100% in 12 days on that position that he started. So those are, I'm only up like 75% because I got in a little late. But but those are the things that you have to do. And the stock actually announced earnings and it was dropping and we decided to jump in on that stock. And that's because we did our homework. We listened to the conference calls, we read the earnings statements, we looked at the financials, and we realized that this was overdone or shouldn't have been done at all. And we just looked at it as, hey, it's an opportunity to make money. You make money on the stock on the buy. The lower the price you can get in, the lower value you can get in on the stock that you've done your homework on, the better it is in the long term in the growth, the profits, and everything else on the stock.
Yeah, and as you were mentioning, when I had bought that stock and then it went up 100%. I was not, I was not thinking that it was going to go up that fast. As you said, we looked at the financials, we looked at the reports, and we said to ourselves, this could be a company that is still going to be outperforming in the long run. That's all I was thinking at the time. And a key thing, because I know a lot of people viewing our channel may be starting out or just starting to get into investing. Emotion is a huge factor when you are investing in a market like this. And that's why we say it is key to do your homework if you are investing in single stocks and listen to the company reports. If the company is still in compliance with their same goal that they had when you first started investing in them and they're going down, only look at the company in the long term. Because seeing that company stock that I had, I was in them before it dropped, and they dropped about 50%. And then I got in at the low. Seeing them drop from 40 plus a share to 21 a share is when I got in, was like, wow. But at the same time, I thought to myself, well, now I can just get cheaper income. Basically, I can buy them at a lower price and get to my next 100 shares to continue to sell premium and gain income that way. But controlling your emotion is going to be a huge thing you have to learn when getting started in investing.
Yeah, that's a good point you brought up. Controlling your emotion. That is 90% of the stock market. And that's why most mom and pop retail investors, people like me and you, that's why they lose in the market. They lose in the market because, we could just use the financial crisis of 2009. When people start seeing their money, losing money, the first thing they think is sell and preserve capital. And in 2009, right when the biggest exodus from the 401ks happened, that same month, that was exactly the low of the market. That was the low of the market. And then it proceeded to go up. And all those people that sold their 401ks, a lot of them never got back in the market for the bull run from 2009 all the way to 2020. So 10 years of capital growth they missed out on because they sold at the bottom. And then you see them jump back in, or you see new investors talking about when COVID happened, when new all-time high or all-time high the next day is coming up, then they jump back in at the height of the market. Now we coming back down and people are scared, and I'm already getting it. I know you had many people at your job asking you, oh, should I sell my 401k? People don't study history, let alone learn from history. But that's why the big institutions win in the market and the smaller mom and pop person don't, because the bigger institutions, they have rule-based investing. So they take the emotions out of it altogether. the regular small mom and pop investor, they're dealing all on emotion, and that's when they take advantage. That's why Warren Buffett said you have to buy when everybody else is fearful, because that's what the big institutions are doing. You see Warren Buffett during this whole run from 2020 to 2022, Warren Buffett, the run up, Warren Buffett didn't buy any companies. Now the market's come down. Warren Buffett has spent $61 billion on investments in companies. You have to be greedy when everybody else is fearful. That's when you're going to make your money. Warren Buffett was buying Apple. Now Warren Buffett is the biggest shareholder in Apple when Apple was down and nobody was paying attention to it. That's why I harp on it a lot of being greedy when others are fearful. Me, I love when the market's down because I'm just buying the discounts because I know I'm buying for the future. I know the company because I'm doing the homework. The company is going to grow in the future, and that's what's going to make me the money. But a lot of people, majority of people, they see them stock down. They're like, oh, it's going to go to zero. If you doing your homework, you should know it's not going to zero. Like the company you mentioned earlier, SoFi was talking about, student loan forgiveness and forbearance. We talked about the Super Bowl and all that. And that stock is, the stock movement itself scary. The most people, they should be nowhere near that stock because it's a stock that will have you sick to your stomach if you're not doing your homework on it. And most people are not going to do their homework on it. Most people invest based off of what they heard their friends say or what they saw in a chat room or what they heard somebody in YouTube say. The key of it is you have to know for yourself. And I've been asked plenty of times, people ask, hey, can I just give you my money so you can invest it for me? That does nothing for them. I refuse to do that because if something happens to me tomorrow, then what happens to their money? I'm I don't want that added pressure on me because I know I'm buying every dip. I can't deal with phone calls and people saying, "Hey, what's going on with my money?" Me, I'm buying every dip. It's going down. I'm buying because I know the future. My goal is the future. The right now, the instant gratification. I don't care nothing about that. I only care about cash flow, investing, cash flow to use to invest, cash flow to use to invest. So, but that's the mindset that the mom and pop investor needs to start adhering to. They need that rule-based philosophy that we're buying the dips and we letting it ride, and we're going to invest in quality companies that we're willing to do homework. Again, if you're not willing to invest in doing the homework, investing in putting in the time to know your company inside and out, then you should just stay and invest in the index fund. It's very passive. It's the top 500 companies. If you get in the index fund that's indexed to the S&P 500, or if you want to invest in the technology companies, the top 100 technology companies, the Apples, the Teslas, the Microsoft, the FANG stocks, and things like that. Just invest in the index and the Qs, and then those fund managers are always going to put the top companies in those indexes. And then you can just keep buying in those indexes over the long term. You will be fine. But going into the individual stocks, it's not made for everybody. So I know it's a lot of people on YouTube, calling out stock names and all that stuff. It sounds good, but I wouldn't listen to them. Hell, I wouldn't even listen to me if I just start blurting out stock names unless I do the homework on them. If you're not willing to do the homework, you shouldn't invest in an individual stock. That's my belief.
A video I had seen with Dave Ramsey, there was, how he has clients call in, but then some actually just send a letter in. This one, it was a woman that sent in a letter, and her, there was the CFO at her husband's company was advising the employees to invest during this time in their 401ks. She had mentioned that her and her husband pulled out their 401k during the recession when the market collapsed, which at that time the market had collapsed 50%. So when it had collapsed, it was her and her husband were left with $400,000. They moved the money to a money market account, which collected very short, very small interest, and just left it there in cash until today. So Dave Ramsey let her know, you didn't just lose 50%, you missed out on 1.2 million because the Dow Jones has tripled since that time. And
Right.
that's only within, 12, 13 years. So that just goes to show you 12, 13 years may seem like a lot of time, but in the short term, it really isn't. And you can, in a time like this where everyone is fearful and you are thinking about selling, you could be missing out on doubling, tripling, quadrupling your portfolio in the near, short-term future.
Right. And that's all the truth.